if you're here as a refuge from the tax session that's happening right now, I've got some bad news for you. There's going to be quite a bit of tax in this one. Now, let's start off. Just by way of introduction, we're both from IFM, as Peter has indicated. The purpose of this session is to go through 2 case studies, and these case studies are based loosely on transactions that we've done over the last 18 months to 24 months. The first case study focuses on increasing a direct stake in a domestic investment. So, a super fund or a PST having an existing stake in an asset and increasing that stake. The second case study deals with a new stake in a international investment context. And once we've done those case studies, we'll open it up for Q&A. Now, case study 1 involves an investor, investor 1, being a pooled superannuation trust, and investor 2 being a listed company or listed fund. Now, each of those investors have an interest in Asset Co. That could be a power station, bridge, no particular assets in mind, but investor 1 holds Asset Co through a subtrust, and it has a 40% interest in Asset Co. And let's assume that investor 2 holds Asset Co through Holdco 1, a wholly owned subsidiary, and it holds 60% of Asset Co. And Asset Co has a loan from a banking syndicate. And with this case study, what we'll be focusing on are the shareholders' agreement and the loan document. So there are 2 sets of relationships here. So put yourself in the place of the PST, investor 1, that's you. There are 2 sets of relationships here. The first set of relationships involves your relationship with investor 2. And typically that's documented in a shareholders' agreement between the subtrust and Holdco 1. Your second set of relationships involves the bank. Okay, and that's typically documented in a facility agreement or a security trustee deed. But in each of those documents, you will have rights and you have obligations. Now, the main right and obligation that we look at typically with these documents are what I call preemptive rights. And in bank documents, it would be a change of control clause. So what's a preemptive right? A preemptive right is a right that you have as an investor in an asset to preempt, to acquire your co-investor's stake in Asset Co in certain events. And I've called those events of default. And typically they would apply if investor 2 wishes to sell down its stake in Asset Co. So why have preemptive rights? There are a number of reasons for that. It allows the investors to align their interest. So if you have a long-term investor, if you take the example of the PST, let's assume that's a long-term investor. It has a 25 to 30-year horizon in relation to Asset Co. The last thing you would want is to have a private equity house in there as a co-investor. They would have a fairly short-term outlook for the asset, and they'll be looking to prep the asset for sale in 4 or 5 years' time. So the main function of a preemptive right is to ensure that you have a say and to ensure that you have an option over your co-investors' shares. So in this case, it's 60%, if investor 2 wishes to sell. And like most preemptive rights, there are carve-outs. So for example, transfers to associates, restructures. But the one that most super funds should focus on in getting a carve-out, if you're going into a direct investment, is for the merger of super funds. You have to have that. Change of trustees. and change of custodians. Now, those are the three typical events which you would face as a super fund in securing a carve-out. Now, there are similar concepts with banking documents as well, and those are what I call change of control clauses. That is, if investor 2 or investor 1 were to sell down, typically these change of control clauses would step in, and typically it would cause a prepayment of the loan that's been made to Asset Co. Okay, so just to remind you, that's the structure, and the change of control clauses in relation to the banking documents down at the banking syndicate Asset Co level, and the preemptive rights are up at the sub-trust and holdco level. So what's the cure to preempt and what's the cure to change of control? Typically, it's consent. If you want to sell down and you don't want to trigger a change of control, in the case of your banking documents, you would need a consent from the banks or the lead arranger or the security trustee. In the event of a sell down and in relation to preemptive rights, you would need the consent of your co-shareholders, your co-investors. Okay, so case study 1, which is based loosely on a real-life scenario that we went through, involves investor 2 simply interposing a holdco 2. Okay, so you've got the structure on the left going to the structure on the right. And all that involves is investor 2 incorporating holdco 2 and holdco 2 acquiring holdco 1. So there's no change of ultimate ownership of Asset Co. It remained at 60%, traced all the way through up to investor 2. Investor 1 retained a 40% stake in Asset Co. Now, does that cause an event of default or change of control? Does that cause a preemptive right to arise in the hands of investor 1? Or does that cause a change of control such that Asset Co would have to prepay its loan to the banking syndicate? Well, this is the exact clause that we focused on in that particular transaction in case study 1. And the shareholders' agreement relevantly reads, an event of default happens if any of the following occur in respect of the shareholder. Okay, so the shareholder in this case, just to remind you, is holdco 1. So that's the shareholder of Asset Co. So there's an event of default which would give rise to a preempt or preemptive right if there is a change in the direct or indirect legal or beneficial interest in more than 50% of the issued shares in the shareholder, so in holdco 1, unless the shareholder, holdco 1, is listed on a recognized stock exchange. And as I said, this is a real-life example. This is straight out of the shareholders' agreement that we've got. So does the insertion of holdco 2 give rise to an event of default? Is there a change in the direct or indirect legal or beneficial interest in more than 50% of the issued shares in the shareholder? I think the answer is clearly yes. And by simply inserting holdco 2, that has given rise to a trigger event for a preempt. And that gave rise to an option in the hands of investor 1, or strictly speaking, sub-trust, to acquire holdco 1's 60% stake in Asset Co. You could just lose your asset by simply inserting a holdco. It doesn't make sense, but that's what the agreement says. Okay, what about the facility agreement? Does it give rise to a prepayment? And what it says here is change of control means at any time the sponsor, in this case the sponsor is investor 2, so it's all the way up, shall cease to own, I should say and control directly or indirectly at least 50% of the voting interest in the capital stock of the company, and the company is Asset Co. So let's go back again. Well, in this case, investor 2 and investor 1 continue to hold 100% of Asset Co, and more relevantly, investor 2 continues to hold 60% of Asset Co, notwithstanding the fact that it holds Asset Co through 2 holding companies rather than 1. So in our example, there is no change of control, but there is a triggering of the preempt. And that gives rise to a right for the PST to acquire the 60% stake in Asset Co. Okay. Now, let's assume that that right is exercised, and we serve a default notice to investor 2 and holdco. Now, in terms of structuring, there will be a number of tax issues, and Lawrence is here to discuss those tax issues.
Here's the fun bit. Hopefully I'll try to keep it non-technical. Really what I'm trying to highlight is the, I guess, interaction of tax with other considerations. So often they have an interplay that needs to be considered. If we look at the structure on the left, that was what it was previously, and on the right, assuming Subtrust exercises its call option, it acquires 100% of Asset Co. Now, what risks and opportunities does this create? And what I'm trying to highlight in the next few slides is not only can the structure impact the tax profile of the asset that you're acquiring, it can in some cases affect the investor structure as well. And I guess to the extent we want an appropriate tax outcome, what ways there are to manage that, having regard to what Josh has already mentioned in terms of restrictions under the shareholder agreements as well as the debt documents. Before we move on, just highlight that prior to the acquisition, Asset Co is part of what's called a tax consolidated group. So Asset Co and Land Co, for tax purposes, for income tax purposes, are treated as a single company. And Land Co also has, let's say it's a power business. It owns land and buildings and equipment. So firstly, let's turn to what it means for the investor. Subtrust, prior to the acquisition, used to be taxed as a trust. And as you know, typically a trust is not a taxpayer. It's the beneficiaries that are taxpayers to the extent the trust fully distributes. Now, by virtue of acquiring 100% of Asset Co, and let's assume that Asset Co has a trading business, it now has the ability to control Asset Co. And the ability to control a trading business can result in Subtrusts becoming what's known as a public trading trust, or some people might refer to them as Division 6C trusts. And typically, public trading trusts are taxed akin to a company. So the trustee itself would be subject to a corporate tax rate of 30%. You'll lose the CGT discount, but it does give the trust ability to frank and pass on franking credits for any tax paid. So question whether it's wholly detrimental, but it certainly impacts the investor structure, and whether it affects what other assets Subtrusts hold. That's something to be considered. Now, for the Asset Co, and let's assume that Subtrust becomes a public trading trust, and that means it's eligible to be the head company of a consolidated group. What it does is trigger a degrouping of the old Asset Co group, and that could give rise to all kinds of consequences. Not all of them could be detrimental, but it could affect things like how does Asset Co use tax losses going forward? So what happens to its tax attributes? Could give rise to capital gains in some cases. But it also gives rise to opportunities. Subtrust could now form a bigger consolidated group. And what that means is it could result in the purchase price that it paid for the shares in Asset Co to reset the assets, the tax cost of the assets of AssetCo. So if AssetCo had things like plant and equipment that it can depreciate for tax purposes, if the tax cost of those assets are reset to their market value, then potentially going forward we have a higher depreciation base, meaning lower tax paid at the company level, and that should feed on to cash flows and hence valuations. So there's both risks and opportunities. It's just something to keep in mind and understand the structures, understand what the acquisition means, and evaluate, do we want these outcomes or do we want a different set of outcomes? Now, just going back slightly, if for some reason we didn't want this particular outcome, the opportunity of resetting the tax base doesn't mean much, or the hassle of going through the degrouping and regrouping is too much of a problem, one option would be if Investor 1 acquired the 60% of AssetCo, these consequences wouldn't follow. But really this is where the interplay between the debt documents and the shareholder agreement comes in. As you recall what Josh said, the call option really technically is held by the subtrust because it is a shareholder of AssetCo. Now, can Investor 1 actually acquire the 60%? That might then require a process of actually negotiating with Investor 2 to get an outcome that you want. For example, a share purchase agreement where the subtrust has an ability to nominate a group company to take on the 60% shareholding. So that gives rise to some, interplay and options as to how we want to achieve the tax outcomes that we want. Wrong way. Now, that's income tax. There are transaction taxes to be considered, such as stamp duty. So there's still share transfer duty in some states. And because we're dealing with the power assets, often the land-rich duty issue arises. So whether the company acquiring has a significant stake in land assets. Now, typically stamp duty is a purchaser's liability. In this case, under the shareholder agreement, the call option is priced at what a willing buyer would pay. And there's some authority out there as to what a willing buyer would take into account of. And certainly one of the things would be transaction costs, for example, stamp duty. And in this example, as part of the negotiations, there is some doubt as to whether, there's some risk as to whether land-rich duty can apply in this case. But rather than reduce the purchase price, the negotiation resulted in, the risk of land-rich duty applying being borne by Investor 2. And there's a risk because land-rich duty isn't, it depends on the valuation of land assets versus non-land assets. And there's a process of agreeing with the State Revenue Office as to whether those valuations are correct. Now, the way the risk was passed on was that we got an indemnity, or Investor 1 got an indemnity for any duty payable. Now, indemnity gives rise to a counterparty risk. The process of negotiating with the State Revenue Office might take a process of a year, 2 years. And in that meantime, question the ability of Investor 1 to meet that indemnity sometime in the future. And to counter that problem, an escrow was put in place where part of the purchase price was put into an escrow, and once the process of negotiating with the Revenue Office was finished, then that was released to either pay for the stamp duty or released to the vendor. So just to summarise, really try to maximise flexibility when in the first place to negotiate shareholders' agreements. And as Josh mentioned, try to contemplate the kind of restructures that you would want in your direct investments. So things like merging funds, changing trustees, changing custodians. So the more breadth that there is to encompass the kind of transactions you would enter into, then the less likely you'll get into these kind of situations. And once you're into the transactions, be commercially aware. By that we mean we wouldn't have found out that the Investor 2 had undertaken their restructure because it was wholly within their corporate group. It's just by virtue of being commercially aware and knowing what's going on in the marketplace that meant we knew that there was this potential call option. And the flip side of that is you also have to be careful in terms of when you're doing a restructure, are you potentially triggering something that might give someone else that same right? And lastly, in undertaking the structuring and planning, remembering the interplay between these various tax and non-tax issues.
Not wanting to harp on here, but I think the important point to take away from the case study is you could lose your asset simply by restructuring, and that might surprise you, but it happens, and it has happened. And in terms of being commercially aware, I think the responsibility of having a direct stake in an asset, the responsibility there is to be aware of what your co-investors or co-shareholders are doing, because that would give rise, well, in this case at least, to a right that you have to acquire your co-investors' 60% stake in Asset Co. And just going back to some of the structuring issues, typically if you do have a right against your co-shareholder, it's not very tactful just to serve a default notice. That would typically cause all sorts of legal hassles. Firstly, your fellow investor would deny that there's an event of default, given that they are listed on the ASX. In our example, they may have an obligation to disclose that to the ASX, and that would be very embarrassing. So I would suggest that if you were to simply issue a default notice, you would have to go through the court system for the next 2 or 3 years. The more tactful way to do it is to present a draft default notice and work out a deal, work out a commercial deal. What you have is leverage, a legal leverage that you can use to work out a commercial deal. Okay, let's move on to case study 2. Case study 2 involves a super fund or a PST acquiring a set of US-based assets. So it's an international transaction. What's up for sale aren't shares or units in the trust. What's up for sale are hard assets. Okay, it could be a power plant or a water treatment plant. Now, what are your obligations in structuring that acquisition? Now, you have obligations under the CIS Act. It's a super fund. A PST is subject to the CIS Act as well. And most of you would know that there's a rule against borrowing. So that needs to be kept in mind. And there may be concerns over carrying on a business. If you were to buy the assets directly, that could be a breach of the sole purpose rule. So the obligations that you have under the CIS Act drives how you structure an acquisition in this case. So there are 4 options. The super fund or the PST could acquire the assets directly. But if it were to do that, leveraging would be difficult because there's a rule against borrowing and there'll be concerns about the sole purpose test. The other alternative is to have a limited partnership. Now again, there's some technicalities here. Some limited partnerships are not separate entities. They are merely a relationship between you and your fellow limited partners. So again, you would face the rule against borrowing. You would face the sole purpose test issue. So investing through some limited partnerships is akin to you investing directly. You could go through a unit trust, and that's very common. That's okay. That would shield or protect you from the rule against borrowing, and that would protect you against the concept of carrying on a business. And the 4th option is to plunk a company in between yourself and the asset, be it a limited liability company in the US or an incorporated company. So the first 2 options, well, the first option doesn't work from your perspective. The second option may work, but you would have to ask the question, is the limited partnership that we're using a separate legal entity, or is it merely a relationship between partners? If it's merely a relationship between partners, you've got the same issues anyway. The 3rd option and the 4th option definitely works. But of course, there's tax.
Just go through the most common, I guess, type of vehicle that we tend to encounter, and that's the corporate form. I guess, as Josh had mentioned, that solves all the potential CIS issues, hopefully. But from a tax perspective, it might not be so good. And really, this example is trying to highlight what are the different tax considerations for an investment, a domestic investment, versus an international investment. So we've got investor one, again, say the PST, invests in a US company. Now, the US company is subject to corporate tax, the US federal tax, at 35%. I haven't put in state taxes and local taxes because that will get too complicated. Now, the returns that come back from USco are dividends, and dividends from the US is subject to withholding tax in the US. Now, assuming that the treaty applies and that particular rate, 5% withholding tax is payable in this case. And investor one, being a PST, is subject to Australian tax at 15%. Now, I guess the point I'll make here is, for Australian foreign tax credit purposes, the general rule is you only get a foreign tax credit where you, as a taxpayer, is personally liable for the tax. So in this case, the company tax at the USco level is borne by USco. So investor one will never get a foreign tax credit for that. So that's 35% leakage. In terms of the withholding tax, that's imposed on the dividend income of investor one. So that's a tax imposed on investor one itself. So potentially it can get a foreign tax credit, depending on how much foreign income investor one has to absorb that. And in this instance, investor one pays Australian tax at 15%. There is 5% withholding tax, so there should be a full recovery of that 5% withholding tax. Now then, the overall leakage of this structure is potentially up to 45% because of mainly because of the company tax leakage at the US level. Now compare that to an Australian investment where, if we assume USco here was an Australian company, now the Australian company would still pay Australian corporate tax at 30%, but that generates franking credits, which it can pass on to investor one. And those franking credits, investor one should either can either use it against its other income, or it could get a cash refund. So in most cases, Australian company tax is not a leakage for a super fund. Foreign corporate tax generally is, and foreign withholding tax can potentially be leakage to the extent it can't fully utilise its foreign tax credits. So really, hopefully that example has highlighted the different focus that we need to face for international investment versus Australian investments. Company tax is generally leakage, so that's really something that the primary structuring focus should be on. And I've got the last point there, a closed structure versus an open structure. Now, we mentioned at the start that the investment is via a corporate form legally, but that doesn't mean that for tax purposes, a company is always taxed as a company. So there might be a different tax treatment for tax versus the legal treatment as a company. But we'll come to that in an example. Just go through some of the common ways that typically would deal with company tax. Now, instead of just investing in equity in the US company, investor one could consider funding the US company via shareholder loans as well as equity. Now, to the extent the interest payments on the shareholder loan are deductible in the foreign jurisdiction, what we've achieved via that loan is take out pre-tax return and extract that from the US into Australia in the hands of investor one. Now, clearly the US government wouldn't like that, so they've got an earnings stripping rule, which if you breach a certain threshold where you've got related party debt above a particular threshold, then it doesn't work. Effectively, the US would deny an interest deduction. So those kind of anti-avoidance rules you need to be aware of in undertaking these kind of strategies. Thin cap is a common concept in Europe, where they might prescribe an arm's length test. So provided the gearing at the asset level is not beyond an arm's length level, that might be okay. Or they might prescribe a safe harbour. For example, like a debt equity ratio of 3:1. In adopting this kind of strategy, the other thing to aware of is to be aware of is withholding taxes. So the interest on the shareholder loan could be subject to interest withholding tax in the US. Again, that could be recoverable by way of foreign tax credits, so not necessarily a cost. Now, we mentioned in the earlier slide that withholding tax on dividends could be a cost to the extent the investor cannot fully utilise foreign tax credits. A common way of dealing with that historically is to put in an appropriate holding company between the investor and the target. I just want to highlight here that there's a trend in various governments to target this kind of planning. In terms of domestic anti-treaty shopping regimes. For example, in Germany, there's a parent-subsidiary directive where dividends within the EU are generally not subject to withholding tax. But just by putting in Luxco no longer works because the German tax rules require Luxco to have not just substance, but also non-passive income. So those are some of the things to be aware of. In the US, there's a limitation of benefits, so treaties don't always apply. And coming back to the open structure, and we mentioned that we can invest legally into a foreign corporate form, but the foreign tax treatment might not always see that entity as a company. So in this case, Investor 1 invests into a legal corporate form, a US limited liability company. So we still don't have those CIS issues that Josh mentioned. But by default, limited liability companies can be treated in the US as a disregarded entity. So it's a nothing for tax. So the US tax in this case, in respect of the assets, are borne by Investor 1 in Australia. Now, Australia has also implemented a set of rules that mirror those US provisions, where if the LLCs are treated in the US as disregarded, Australia will also disregard them. So again, the Australian taxpayer for that foreign income is Investor 1. So in this case, we've got I guess going back to the original principle that to get a foreign tax credit in Australia, you have to have the guy that's getting the income being personally liable for the foreign tax. In this case, we have an alignment in the taxpayer, being Investor 1, being responsible for both the US tax and the Australian tax. Now, as you'll see, the US tax is 35%, but the Australian tax on the same income is only 15%. So what do we do with the 20%? Now, that really depends on whether Investor 1 can utilise those excess foreign tax credits. And if it had other foreign income that it could use it against, then we can potentially reduce the tax leakage on this structure back from, if you recall from the start, up to 45% or more, down to potentially 15%. So that's a huge difference. And I'll just mention here that you may already be aware there's recent change to the foreign tax credit rules where there used to be a concept of classes of income, and the way you utilise your foreign tax credits is quarantined within a particular class. And that's dropped away since 1 July 2008. So it's really given this opportunity to mix your dividend income, interest income, as well as this kind of trading income, and utilise it as a single pool. Now, the benefit of the structure is you get the ability to utilise foreign tax credits, but as I mentioned before, the responsibility for US tax and Australia tax in respect to the asset now follows up to the investor. So what you're reporting on for tax purposes isn't just dividend income or interest income. You're looking at line by line, tax depreciation, what sales we've got. So it really requires you to have access to that level of information, and you've got your state tax compliance in the US, you've got your local tax compliance in the US, and that might also fall between different entities within the structure. So for example, US state taxes might be imposed on the LLCs in some states, but in other states it's imposed on Investor 1. So it blurs the lines between the asset and the investor, and really requires a lot of communication between the investing fund and the assets to make sure nothing falls between the cracks, and that you can get access to the kind of information you need to meet your Australian tax requirements, to meet your US tax requirements.
If you haven't gathered by now, the recommendation that we have is to have a good look at the LLC structures. Instead of adopting the old method of using a corporate in the US and leveraging that up using shareholder loans, consider using a flow-through structure. A flow-through structure involves a US LLC, which fits the CIS obligations that you have, so it quarantines you from the borrowing rule and the carrying on a business rule, but it's an open structure that allows you to obtain the foreign tax credits, and by doing that, you have effectively lowered your tax rate on the investment from 45% to 15%. Okay, so at the very least, have a look at these structures. Now, there are 3 more slides to go, and these involve director appointment rights and other rights that you have under shareholders agreement. I'll go through each of those comments fairly quickly. Okay, so let's assume that investor 1 is investing into the US asset together with investor 2 and investor 3, and once again, because it's a co-investment, you would have a shareholders agreement which might be contained within the US LLC agreement. And the first thing that you would look for typically is your right to appoint a director to the board. Okay, there has to be some form of control, and from what we've seen, typically you would get a director based on a percentage holding of the investment. For example, 1 director for every 15%. Now, on the assumption that super funds would go in as a minority, the issue for you is clubbing and lending. By clubbing, what I mean is the ability for you, if you have less than 15% in this example, to club with another investor, another minority investor, to jointly appoint a director to the board. Okay, so if you hold less than 15% in this example, make sure you have the right to club. Now, if you are a minority investor and you have around 15%, you should look for the right to lend or borrow. So, for example, if investor 1 has 16% and investor 2 has 14%, investor 1 could lend its 1% to investor 2, for some sort of fee or compensation or a sweetheart deal. So that's something that you need to look out for as well if you're a minority investor. And typically, directors would get 1 vote per director, but there have been occasions where what's been suggested to us is a vote based on percentage holding of your appointing shareholder. And again, if you were a minority shareholder, you should push back on that. The norm is 1 vote per director, not based on percentage shareholdings. You will find some sponsors out there pushing that line. I'll skip the last point. The other point to look out for is the quorum for a directors' meeting. If you are a minority investor, you need to make sure that the quorum, there's only a quorum if there's a representation from all camps. So what I mean by that is minorities have to be included in the quorum in order for there to be a binding quorum. Now, the approval thresholds, you could have ordinary supermajority or unanimous thresholds, and typically board reserve matters require supermajority. Shareholder reserve matters require supermajority vote at the shareholder level. Now, what you put into those matters is really up to you, but I could roll off a couple of things. For example, related party transactions, you would want that to be a board reserve matter. Imagine if you've got a sponsor out there that holds a large chunk of the asset, wanting to merge that asset with another asset which is underperforming. Do you have the ability to stop that? The only way you could stop it is to have the ability to veto the transaction at the board level, and for you to do that, it has to be a board reserved matter. Okay, so that's one example. There are other examples as well. For example, buybacks, dilution, liquidation, sale of the business of the company, If you want control for all of those issues and you are a minority shareholder, you need to have that at least as a board reserve matter. A couple of other things to point to: confidentiality and access to information. These are fairly common in shareholders' agreements as well. You need to have a carve-out as a super fund. You need to be able to tell your members and your fellow investors or your investors about the asset. So make sure that there's a carve-out that allows you to do that. And the next point to look out for is a non-compete. This really only came to my attention when we looked into an investment which carried on a business that's very similar to another pre-existing investment. And we reviewed the shareholders' agreement for the pre-existing investment. There was a non-compete in there which basically said you cannot acquire or carry on a business which competes with this pre-existing investment. Now, what does that mean? That's a potential restriction on you acquiring a new asset which competes against the old asset. So just be aware of that. And lastly, tag-along and drag-along rights. I'm sure your lawyers will tell you what those are.